Welcome to the Deep Dive. Today, we're really getting into the weeds on the recent Kennametal earnings call. We'll cover their fiscal Q4 25 results, and maybe more importantly, the really cautious outlook they just gave for fiscal 26. If you were watching the market right at the open, well, you know it wasn't pretty.
No, not at all. The numbers came out pre-market, and then bam, right at the U.S. Open, the reaction was immediate and pretty brutal.
Yeah.
Shares dropped something like, what, 18%? That kind of move?
Yeah.
It tells you the results missed, sure, but also that the guidance was way, way worse than anyone was expecting.
Definitely. So our job today is really to unpack why the market reacted quite so negatively. What drove that pessimism?
Okay, let's start with the miss itself. An 18% drop isn't just a slight miss, right?
Yeah.
The Q4 numbers were, well, weak across the board versus what analysts were looking for.
Yeah.
Adjusted EPS, that came in at 34 cents.
Okay.
And the street consensus was more like $0.38 to $0.40. So a clear miss there.
In revenue?
Revenue was soft too. $516.4 million against expectations of $527.5 million.
So missing on both top and bottom lines.
Exactly. And it wasn't just missing the target. That revenue number meant an organic decline year over year of about 5%.
5% organic decline. That's a pretty serious signal of ongoing weakness. But, you know, what really jumps out, I think, is the hit to profitability. Where did margins land?
The margins. Yeah, that's really the core of the pain here. Adjusted operating margin, it compressed dramatically down to 7.4%.
Wow, 7.4%. What was it before?
It was 11.5% in the same quarter last year. So that's what, more than a 4-point drop in just 12 months?
Oof. That really shows the operating leverage issue, doesn't it, when volumes drop for an industrial company?
Precisely. It's a huge fixed cost absorption problem. You've got lower volumes, but you also had wage inflation, and they specifically called out higher raw material costs that just, eroded the base. They're struggling with leverage.
Yeah, losing that much leverage really highlights how sensitive these industrial models are. And it sounds like this isn't just a blip. Management said demand's been soft for how long now?
Yeah, they flagged 8 straight quarters of broad market weakness, 2 full years.
2 years, okay.
So that's the context, right? That persistent macro drag is the backdrop for their new guidance.
Right, which brings us to the forecast. If the recent past was weak, how are they guiding the future? Because this seems to be where the market really lost confidence. The FY26 guide really shook things up.
Yeah, the FY26 outlook basically forced this huge earnings reset. Sales projection first, they're guiding $1.95 billion to $2.05 billion. Okay, range there too.
But the real eye-opener, the real volatility, is in the adjusted EPS guidance. They set this massive range, and 90 cents to $1.30 per share.
Hold on, 90 cents to $1.30? That's a 40 cents range on the bottom line.
It's huge. And crucially, even the top end of that range, $1.30, it's well below where the street consensus was. Analysts were thinking more like $1.44.
So best case scenario is still a big miss versus prior expectations. And that wide range, I mean, doesn't that just scream uncertainty? Like management themselves aren't sure what happens next. That's exactly how the market read it. Extreme uncertainty. And if you dig into the assumptions behind that guide, you see why they're so cautious.
What are they assuming for volume?
Volume. They expect it to range from -5% to flat.
-5 to flat. Wow. Okay, so that's a pretty bleak outlook on global industrial activity for the next year.
It really is. It means basically all their projected sales performance, if any, isn't coming from selling more stuff.
So where does the growth or stabilization come from then? Price hikes, FX?
Yeah, exactly. They're projecting tailwinds from pricing, including those tariff surcharges they mentioned. That's expected to be about a 4% benefit.
Okay.
And then favorable foreign exchange adding maybe another 2%. So yeah, they're pushing price to offset the volume weakness. But like we said, without volume, you don't fix that operating leverage issue.
Right. And looking across their different business segments, their end markets, is anything actually growing? Or is it weakness everywhere?
It's really a split story. Aerospace and defense, A&D, that's the one relative bright spot. They're guiding that for low double-digit growth. Seems driven by, higher aircraft build rates.
Okay, so A&D is holding up. What about the rest?
The rest is basically the drag. Transportation, general engineering, earthworks, all projected flat to down.
Down how much?
Mid-single-digit declines expected for general engineering and earthworks. And even energy, which they guide flat in revenue. There's a catch. Yeah, management noted that the flat revenue is because higher prices are offsetting an expected mid-single-digit decline in actual volume tied to lower rig counts. So underlying demand weakness there too.
Okay, so with those kinds of headwinds, both near-term and seemingly structural, it makes sense they're leaning hard on what they call self-help, basically saying the market won't save us, we have to fix our own costs. So what are the specifics? What actions are they taking to try and bridge this, pretty big earnings gap?
Well, they've announced a pretty significant overhaul and expansion of their existing cost-cutting program. They're taking the annualized run rate savings target way up. It was $100 million. Now they're aiming for $125 million.
Wow, another $25 million.
Yeah, targeted to be fully realized by the end of fiscal 27.
So increasing the target by 25%, that's pretty ambitious. How are they planning to get there?
Yeah.
And what does that tell you about how they view the future market?
It involves pretty aggressive footprint rationalization.
Yeah.
More facility closures, basically. They've upped the total number of consolidations to 6 facilities now.
6? Wasn't it like 3 to 5 before?
Well, exactly. Up from 3 to 5. And they've also pushed the timeline out, extending it to the end of fiscal 28.
So more cuts taking longer.
Right. And what that signals is that management sees these capacity and cost issues as, well, deeply structural. They're basically saying, look, our old assumptions about market growth, they mentioned 1% to 2% growth, those are just no longer relevant. They're right-sizing the company for potentially flat or even shrinking volumes long term.
Okay, but this is where the skepticism always creeps in, right? Kennametal, like many industrials, has gone through restructuring before.
Yeah.
So the question becomes, how quickly do these new, bigger savings actually hit the bottom line? And is this plan the one that sticks? And that's the core of the near-term risk, the timing. Management was pretty clear. They expect these restructuring savings in FY26 to be weighted 40% in the first half and 60% in the second half.
Back half weighted.
Exactly. So the majority of the financial benefit doesn't really show up until later in the year. And investors, they generally hate that.
Yeah, it means more pain now, promise of gain later. Increases the execution risk too, doesn't it?
Definitely. Poor near-term visibility delays the earnings recovery. It's a tough story to sell for the next, say, 6 months. So the market's being asked to wait potentially a full year for the benefits to really kick in, all while volume might be shrinking. That's a tough pill to swallow.
It certainly is. But what's interesting, though, is that despite this earnings reset, they seem pretty confident about their cash generation.
Really? How so?
Well, they reaffirmed their commitment to capital returns. They actually returned $122 million to shareholders in FY25 through buybacks and dividends.
Okay.
And for FY26, the guidance for free operating cash flow is strong. They're guiding it at roughly 120% of adjusted net income.
120% conversion, that's pretty high.
It is. It suggests that even if the reported earnings, GAAP or adjusted, look weak, they believe these structural changes will improve the underlying cash flow. It shows management has conviction, at least in the long-term payoff.
Okay, so if we kind of synthesize the reaction, the market immediately hammered the stock because of the volume decline and the weak EPS guide. But management spent a lot of the call talking up the future, the $125 million in savings.
That's the disconnect, exactly. And one specific point on margins I think is worth highlighting is this weird raw material situation they have, especially with tungsten.
Ah, tungsten, right. The odd thing there is tungsten costs are up, which usually signals strong industrial demand, right? But Kennametal's volumes are down. How does that work? It seems contradictory.
It perfectly illustrates their problem. Tungsten costs are up significantly, yes.
Yep.
But it's happening without the usual pickup in industrial volume that normally goes along with it.
So they get the cost inflation without the demand benefit.
Precisely. Normally, higher raw mat costs get passed through with higher prices, and higher volume helps absorb fixed costs, boosting margins. Here, they have to raise prices to cover the tungsten cost, and they say they expect to get price cost neutrality by late Q3 or Q4 of 26.
Okay, so eventually they cover it.
Eventually.
Yeah.
But crucially, the lack of volume leverage means those price hikes are just playing catch up. They're not really improving margins much. It limits that usual positive correlation. They're fighting inflation without the volume tailwind.
Got it. So, okay, pulling it all together, what's the main challenge for the company over the next year or so? It feels like it's all about execution and proof.
The core challenge is simply proving, that these aggressive back half weighted cost cuts can actually stabilize margins and fight off those raw material headwinds while their main industrial markets stay soft. The first half of FY26 honestly looked like a real operational grind. They're basically relying entirely on that Canadian strength to avoid things getting much worse elsewhere.
All right, let's shift gears slightly. Time for our segment. This is not financial advice. We need an outrageous, but maybe plausible, trade idea based on everything we've just discussed. Something leveraged to this turnaround story, or lack thereof.
Okay, outrageous but plausible. Given the huge stock drop, the near-term pain, but also this big long-term restructuring promise, I think the pitch is a short the near-term pain, buy the long-term turnaround strategy.
Okay, intriguing. Short the pain, buy the turnaround. Lay out the mechanics. How would that work? All right, action one. You short the common stock right now. You're betting on that near-term pain we just talked about. The volume guide is weak, -5 to flat. The cost savings are back half-weighted, 40-60. So Q1, Q2 earnings. They're likely to be pretty rough, and the market will probably punish that. You're betting against near-term execution and on the macro drag continuing for, say, 6 months.
Okay, so short the stock based on the next 6 months of likely bad news. Where's the second part? The hedge or the leverage bet on the future?
Simultaneously, or maybe shortly after, you go out and buy long-dated, out-of-the-money call options, like expiring in fiscal 27 or even fiscal 28.
Long-dated calls. Okay, why?
This is your leveraged bet that the $125 million cost program actually works, that this time the restructuring sticks where maybe previous ones didn't fully deliver, and crucially, that the industrial cycle eventually turns back up maybe in 27.
So you're betting on structural improvement plus a cyclical recovery. Exactly. If, and it's a big if, but if they successfully rebuild margins, say back above 10% on this newly leaner cost structure, then when volume does finally return, the operating leverage on the upside could be massive. That leads to potential multiple expansion.
And the outrageous part is?
The outrageous part is betting heavily on the success of a multi-year restructuring that's even more ambitious than their previous targets, especially given the execution risk. But if they do pull it off, those long-dated calls could have an explosive payoff.
Got it. A classic pairs trade structure almost. Shorting the immediate risk, buying the long-shot turnaround potential. Okay, let's quickly recap the main takeaways then. Q4 miss, FY26 guide.
They definitely reset expectations lower. Big time.
Yeah, big reset. Puts enormous pressure on executing that larger $125 million cost-cutting plan.
A&D seems to be the only real growth engine holding things together for now. The rest of the portfolio faces some serious volume headwinds. Makes the first half of this fiscal year look pretty challenging. And I'll leave you, the listener, with maybe one final provocative thought here. Management explicitly said they're prioritizing right-sizing capacity. Why? Because their old market growth assumptions, 1% to 2%, are, quote, no longer relevant.
Right. They're planning for flat to negative now. Exactly. So think about this. If a major player in industrial cutting tools, a business fundamentally tied to global manufacturing output, is structurally resetting its entire capacity for potentially flat to negative volumes for the foreseeable future, what does that imply about the demand outlook for the entire industrial manufacturing supply chain?
Yeah. Is this a canary in the coal mine situation for broader industrial production?
Could be. Are we maybe facing a much longer period of stagnant or low-growth industrial activity than people think? Definitely something for you to mull over as you look at your own investments.
Indeed. A sobering thought. And just a reminder, everyone, all the content and discussion here is purely for informational purposes. It is absolutely not financial advice. Thanks for tuning in for this deep dive. We'll talk to you next time.